start with the intro. And by the time we start sharing the presentation, I think we should have more people. Yeah. Hi, folks. I'm Kaushik. I've been interacting with all of you on the group, and it's finally nice to see you all in the call. So we wanted to do this, and we are planning to do this every week. At least that's what we have been planning. And I'll keep you posted on the group. You can actively check out for my messages and any updates on the webinar or any upcoming sessions that we are doing. And we have Vikas, Nikhil as part of this call. Vikas is a co-founder and chief investment officer at Multipl. And we have Nikhil Joseph, who is heading the investment team at Multipl. So thank you so much again. Vikas, over to you. You can get started with the call, with the session and share your slides. Yeah.
Thank you, Kaushik. Good afternoon, everyone. Thank you for taking out time. As we had mentioned on the group earlier, this is more like a discussion rather than a session. But yes, we do have a few slides to just quickly walk you through the process and the philosophy, which will itself address a few of the questions which were raised in the group or shared with Kaushik earlier. And post that, we will, if you have any further questions, please feel free to ask. You may keep posting your questions in the chat also. So Nikhil also is here, so he would respond, and maybe a little bit of the presentation when he also does, I will respond to those queries. And then we can take, verbal questions as well later on if there are any. I will just share the presentation. Do let me know if you guys are able to see it. Is it visible?
Yeah, we can see it, Vikas.
Yeah. So these are some of the questions which we will be addressing, questions raised by you. How does Multipl pick mutual funds? Are there any exit loads? Why Multipl is giving only certain amount of returns while other platforms are giving higher? How do we approach rebalancing? And a bit more of info on the investment team, which was also sought. Now, different goals have different timelines. We don't have goals which all end at the same time. Some are short-term goals, some are medium, some are long-term goals. The short-term ones might be as short as 2-3 months, and the long-term goals might be as long as 20 to 30 years as well, especially if they are retirement goals or wealth creation goals. While we have different goals with very different timelines, right now everybody is thinking that can there be a single solution to that. Equity markets have been doing very well. However, for most Indians, in fact 2/3 of them, the markets have started only post-COVID, as if markets did not exist before that. They have existed. Equity markets in India have been there for the last 150 years, but majority of the people don't have any experience of markets before COVID. The number was around 3.5 crore Indians who were exposed to markets in some form before COVID. And today, more than 10 crore Indians are exposed to markets either directly or through mutual funds. Now, returns have been very good for markets, for Multipl as well. So it's not that Multipl does not allocate equities, we do. And these are the returns given by some of the funds categories that we have recommended. And these are the 1-year rolling returns, historical 1-year rolling returns of the funds which we have recommended compared to the benchmark. Also, the volatility compared to the benchmark. Also, we do have an offline service for HNIs and NRIs, wherein the returns that we have generated by constructing customized stock portfolios, you can see for the last 1 year have been close to 50%. A lot of mutual funds have also given similar returns. Of course, the composition might be different. Some of those mutual funds might be small cap, mid cap funds purely. In our case, it's more of a mix of different kinds of funds. Can equity be the solution for all? The returns have been great. So can it be a one solution for all the goals? It might seem like, right, especially considering the returns. And yes, equity is a very good asset class for the long term, as we can see here, irrespective of the political regime. Equity returns have been kind of mid-teens in India because India is a growing country, and real returns also have been around 6 to 7%. Now, when we look at these charts, while the returns are all similar, but we can see that there has been a lot of volatility in these returns. It's not like every year it is 15%. There might have been years, where returns might be more than 50%, and there have been years where it has been a negative 30, 40, 50% also. Interim periods, not necessarily a annual calendar year, but there have been periods. So we have seen quite a few crashes. When I say a crash, it is like more than a 20% decline. And we have seen many corrections during these last 20 years. When I say correction, it is a more than 10% decline. So while equity is popular today, there are other asset classes too. And each asset class has its own purpose in the portfolio or for the goals that you have. So apart from equity, which we just spoke about, there's debt. There are commodities like gold, which probably add to portfolio diversification, especially if you are doing comprehensive financial planning and looking at the portfolio as a whole rather than just as individual goals. It is an instrument which is suitable for the short term, and the returns, while might be lower, there is a greater assurance of those returns. And as we can see here, for the various asset classes, not that the same asset classes at the top every year. The performance varies with time, and in each calendar year you would see a different asset class here. Of course, equities is more prominent, but which form of equities again? You might see in some cases, mid caps like in 2012 and 14 were at the top of the list. But if you see at 2018-19 period, you can see that the correction was 15% in mid caps and 30% in small caps. Also, gold, like in 2008 to 2011, gold was the best performing asset class in each of those years. But if you see the next few years, 2012 onwards till almost 2017, it had been the worst performing asset class. Then again, gold, there was some bit of revival in gold in the last few years. So while equities might be looking as a single solution today, like many times people call and say that we give debt funds for some short-term goal, and but my small cap fund has given me 20% or 30% or 40% returns. Now, 1 year ago, for a 1 year goal, would I give a small cap fund which has such a high risk, and especially if the valuations are a bit elevated? It's not like small caps are as cheap as they were in 2020, because at that time small caps were pretty reasonable, and a significant exposure to small caps even for a period of, say, maybe not 1 year but for 2-3 years might have made a lot of sense. But today's valuation, buying small caps for even a 3-year goal might be risky. You might end up with returns, single digit returns in small caps or mid caps. But then it is non-linear, right? So before they go down, they might go up another 10, 15, 20%, but who knows how much that would be and by when, and when the U-turn happens. Nobody can predict that. What we can do is act based on a valuation framework. And if the valuation framework suggests that they are expensive, then we have to work accordingly, rather than just taking a bet on the momentum in the particular asset class or the sub-segment of that asset class. Because as the valuations rise, the probability of a significant or meaningful return reduces. And at today's valuation in small and mid caps, that probability is single digits that you might a double-digit return. The probability of earning a double-digit return over the next 1 to 3 years in small caps and mid caps is single digit. Now, would you bet on a 5% probability or would you bet on a 95% probability? Now, coming to mutual funds, which is the instrument that we are using on Multipl. Now, mutual funds is just a way to take exposure to different asset classes, right? It is not a separate asset class. It's just an instrument to invest in one of these asset classes. Now, there are different types of mutual funds: debt mutual funds, equity mutual funds, alternatives, and hybrid. And on Multipl also, we are offering most of these categories, depending on the suitability and the requirements, the risk profile, etc., which we will delve into more detail ahead in the presentation. And what is really important is that the selection has to be based on specific needs and the relative asset valuations. So right now, if over the next 1, 2, 3 years, the probability of debt giving me a 10% return or a 9% or a 8% return is similar to the probability of a small cap fund giving me a similar return, I would ideally choose debt fund because the volatility and the risk is much higher in the small cap fund. Index funds is another option, which there was a query regarding that in the group as well. That are we giving index funds? So right now we are not giving any index funds because in Indian markets still there are opportunities to outperform the index. There are funds which have been outperforming the index, and if we are able to select those funds again for the long-term goals, funds which can beat the index, we would rather choose that than giving an index fund. But again, I mean, for somebody, when we are talking generally, it might be a better option than completely avoiding equities, especially for people who are very risk averse. Maybe it might be a better option. But on the app, we don't give it because we think there are active funds which can do better. Now, coming to SIPs, again, I think this is something most of you are familiar with, so I wouldn't take much time on that. I'll now hand over to Nikhil to just quickly walk you through the process that we follow. So Nikhil looks after the mutual fund research and Multipl, and he can walk you through quickly through the process in the next 5-7 minutes, and then we will make it more interactive. Whatever queries you have based on this or otherwise, based on whatever we are presenting or otherwise, we will be happy to take those. Nikhil, over to you.
Thanks, Vikas. What we are looking for when we make an investment or investment selection is how much it is suitable for the purpose that we are doing and our personal risk profiles. Right? So what you have to keep in mind is what is your risk profile, how much diversification is good, too much diversification is also not too good, and also how often should you change your allocation. Investment for a goal is a journey. It is not a point in time action that you select one and just wait it out. Say you want to retire after 30 years. The same fund may not necessarily achieve your goal. You may have to look at the valuations, like Vikas showed, equity markets are volatile. So you may have to take appropriate actions for it. Now there are over 1,500 mutual funds, right? What most of us do is probably read some recent reports out in the newspapers, or we follow trends, ask friends for opinions, and invest, or at most look at the recent performance and invest in the funds which have been best performing. But is that the right way to do it or not? We don't think so, but there are additions or improvements that have to be done to that process, and we'll just walk you through it in the next slide. So there are around 1,500 direct mutual funds. Within these 1,500 funds, to select, like I said, over diversification is not helpful. You probably need not more than 3 to 4 funds to achieve any goal, because within those funds there are usually more than 50 securities, which is diversified enough. Now, while selecting out of 1,500 funds, what are some things that we need to take care of? So one is fund performance, which we are reasonably aware of. Usually people look at last sometime fund. And it is also important to understand that recent performance is not a guarantee that it will continue. What you have to look at consistency of performance, the performance over different cycles, and performance relative to, say, benchmark and peers. So we'll walk you through all of those. But basically, how we select the funds is following our SLR philosophy, which is safety, liquidity, and returns. So safety of capital is paramount. We do not want to see a permanent capital loss. There could be a temporary loss because of market volatility, but we will not be comfortable accepting permanent capital of loss. Permanent capital loss. Liquidity is that we need the funds when we require. When we need to take some action, we want that money to be available to us. We need to be able to execute the transaction smoothly. And returns is something that we believe follows, if you follow a disciplined asset allocation and security selection approach, returns will come based on the characteristics of the asset class. What is more important is the safety of the capital. So we'll just walk you through how all of these work and how we come to selecting, say, 1 to 4 funds out of a total of 1,500 for every goal. So starting with asset allocation. The asset allocation, so I'll walk you through step by step as to how we approach selection of mutual funds at Multipl. So first thing is within asset allocation, right? Like we saw, like Vikas had presented, there are various asset classes: equity, debt, high grade, alternatives, gold, etc. Now, and also he showed that mutual funds cater to most of these asset classes. We have debt mutual fund, equity, hybrid. We also have gold mutual fund, silver mutual fund, ETS, international funds. There are so many options. So basically, it caters to almost all of the asset classes. Now, we have our own proprietary market valuation model. It has a high correlation to performance. We have maintained it over a period, and it is going back to around 25 to 30 years. And it's fairly accurate. It's almost impossible to predict the market accurately, but it's fairly representative of the extremes at least. Then we look at the interest rate scenarios, how the interest rates are, what is the central bank RBI stance, what is the US Fed, and all. And macroeconomic and geopolitical risks are also important to understand before taking any asset class exposure. Stable and stable environment is always helpful for businesses. And sentiment and capital flows also lead to some bit of movement, short-term volatility in those markets. Within the asset class, say primarily it's equity versus debt, or equity, debt, and alternatives. So in the last 1 year, equity markets have been really expensive, especially the mid cap and small cap today. And if you look at the interest rates, they have also kind of been rising since COVID. It was around 4.4% RBI made it post-COVID, which is now close to 6.25. Now, you look at the actions that RBI takes, it determines the money flow in the market, and it also has an impact on the debt funds. Whenever interest rates rise, the capital gains go lower or are negative. Whenever interest rates fall, the capital gains are higher. So similarly, right now, we believe that we've almost reached the peak of the interest rate cycle. Inflation is relatively under control. So we don't think further rate increases are going to happen. Cuts may be postponed by a few quarters, but it's more likely that cuts are going to happen in the future. And it's already getting priced in the debt market. So whenever the interest rates fall, the debt markets will benefit, especially the longer durations. And based on that, and also given that it's historically high, or one of the higher types of debt interest rates, debt funds prove to be less volatile and provide a decent risk versus return for short term. And equity and hybrid funds are more preferred for long term. Like we saw earlier, although the asset class returns vary, equity has been a long term outperformer. Coming to the category selection, within the asset classes that we talked about in the previous slide, there are various categories. So equity will have 10-15 categories, debt will have 10-15 categories, liquid is one category, hybrid has many categories, and so on. So within those, how do we select the categories? So category selection is based on relative valuations, like we just shared the large cap versus mid cap versus small cap. We believe that mid cap is significantly overpriced, followed by small cap, followed by large cap. So it's based on a relative valuation. How do we select the category? If we look at the, we also need to understand the expectation of the category performance from in the future. Because like we mentioned, what has performed in the past is not necessarily going to perform in the future. And we need to avoid emerging risk in some categories, especially the scientific optimism, and matched with suitability for the goal durations. Now, when we talk about short term, like we discussed, debt funds are good right now for a reason regarding the interest rates. And within debt funds, we like ultra short and low duration, or we rather allocate ultra short and low duration today for most of our users with goals less than 12 months, because it closely matches the duration of the papers they are holding within the portfolio, closely match with the goal duration, which is 6 months and 12 months. It has relatively low volatility. So we have reasonable returns with very low risk, helping us achieve the goals. Within long-term category, the increase we increase the proportion of equity and hybrid based on the goal time horizon. We prefer flexi cap and balanced advantage category within equity and hybrid respectively today. Flexi cap we prefer because the fund manager has the flexibility to move between large, mid, and small cap, not fixed or rigid exposure to mid or small cap, which is what we prefer given the current valuations, current high valuations in those categories. Balanced advantage again has a component of debt which reduces the volatility, and given that debt returns are on a higher side, it will probably give a kicker to the returns as well. Plus, most of the balanced advantage funds are also large cap heavy, the funds that we are allocating. So that is the reason to pick that. Small and mid cap are significantly overvalued today. We were allocating them back in 2023 last year, and from 21 to 23 actually. But we are not allocating it anymore given the valuation. We will allocate it in the future if we see valuations are at a similar level. We avoid purely large cap categories today because research has shown that most of the only large cap categories are not able to beat the index. That's why, like I said, we prefer flexi cap. We avoid sectoral and thematic funds because usually these themes and sectors are cyclical. Most of the businesses, by nature of business itself, is cyclical. Back in 2007, infrastructure was on a boom, and it took almost 10-15 years for infrastructure funds which were invested at the peak to recover values later. We have seen various cycles of other categories, other sectors, and we tend to avoid it. A flexi cap manager can manage exposure to sectors as per requirement. Then after we have selected the category comes the scheme selection. Now scheme selection is done based on 20 plus quantitative and qualitative parameters. Within the quantitative parameters, what we want to understand is this: a few of us, or rather a lot of us, might be doing some bit of part of these, but all of these are important. So historical rolling returns. So point in time returns are again not very insightful. If you look at any particular peak, the 1 year return will look good, and so will all the other period returns also. And if you look at any after a certain crash at the lowest time, say March 23, 2020, when COVID impact was highest on the market, the 1 year period returns will probably look bad. But what we need to focus on is rolling returns. Rolling returns means that every day's 1 year return. So, for example, if I'm talking about 1 month, this February, let's say 2024, what was the 1 year return previous 1 year on February 1st, on February 2nd, on February 3rd, depending on that, the average of those is the historical is called the rolling return. So we look at rolling returns for 1 year, 3 year, 5 year, and 10 year horizons. We look at the volatility of the returns, how consistent have the returns been. It should not be the case that sometimes the returns are extremely good and sometimes they're extremely bad. We prefer more consistency. Performance against peers and benchmark. So in absolute, like we saw last 1 year or rather 3 year period, market has probably, the Nifty 50 has probably grown 2.5x or even reaching close to 3x now. But at the same time, if your fund is giving you 2x compared to a 2.5x at the index, it's not outperforming, it's underperforming. It's not a fund that only based on this parameter is a preferred one. So just looking at returns may not give you the answer. You have to compare the returns against the peers, that is same funds in the same category, and the benchmark. Then the yield of the portfolio for debt, what kind of returns can we expect there? Expense ratios, exit load. Someone had asked about the exit load. So there are exit loads in various funds, especially equity. Most debt funds don't have an exit load. Equity funds will have an exit load of 1% for the money invested in the last 12 months. Usually that is the case, but we factor in all those costs, and these are costs levied by the AMC. We factor in all of this before any recommendation. So like to like basis, net of cost, it should be beneficial for your goal is when we'll allocate. We also have a minimum criteria of 500 crores of AUM, because like we mentioned, liquidity is one of our prime concerns, safety, liquidity and returns. So liquidity, we need a higher size of fund. We don't want a very, very small fund. And 3 years in existence, because like we mentioned, without a proven history, it is very difficult to allocate a fund or assess the performance of fund. We can make a couple of exceptions for some really good fund managers who have displayed consistent performance over long periods, say 10 years, and suppose they are starting a new fund or something of that sort. But usually we'll not go for new funds. You will never see NFOs being allocated on our platform. So then on the qualitative parameters, we look. So quantitative is rather relatively easy to gauge because the information is all out there. Qualitative is slightly more tricky. You have to, it develops over time. So something that we want to understand is the fund manager philosophy. What is the fund manager, investing and thinking and investing, how he thinks, how he or she thinks. Adherence to processes. Various AMCs will have various processes and their scheme and various schemes will have different objectives in their scheme document. We want to see that the fund managers are actually delivering what they are promising or what they started out to with. So unless just having the process doesn't cut it, we need the fund managers to adhere to the process. Historical actions in good and bad times. So we have seen multiple cycles, and like we prefer funds with slightly more bit of history. Most of the funds we allocate have 10-year history. So we want to see how they have performed in various cycles, good and bad. The historical treatment of unit holders. Often there are actions taken by the AMCs which are unit holder friendly or unfriendly. We want friendly management to be handling our money. Exposure to risky companies and bonds. So there are sometimes known risks in the market. So it will display if some fund managers are taking excessive risk. And ease of operations, we want smooth movement. Like we have rebalancing of the funds, so we want some AMC which will provide a higher number of categories of funds so that we can switch seamlessly. So that is one other qualitative parameter to look at. Then finally, after scheme selection, so what we have done is selected the asset class, asset allocation, the category selection, and the scheme selection. After the scheme selection is done, what we want to understand is, does it fit in with your risk profile or your goal? So what you have to look at is the risk profile of the customer, which is you, the time horizon of your goal, the amount of investment that you're looking to do, is it suitable for that, and the goal purpose, like for what kind of goal are you investing, how important that is, what kind of risks are available there. And finally, the monitoring and rebalancing comes into play. So like I said, investing is a journey, especially for longer duration goals, and you do not want to be just not monitoring it. So we at Multipl monitor the allocated funds on a continuous basis, and we will be making the rebalancing based on few factors mentioned here, like changes in market valuation. Like I am saying today, mid and small cap is expensive, and we are not allocating it. Sorry. Tomorrow, if say 1 year down the line, mid and small is extremely cheap, and say some other category, flexi or large, is expensive, and you have funds in that category, we will ask you to move your funds from category A to B depending on the suitability. We just did this exercise in February also for around 300 users based on their respective exposures, and we may take further actions depending on the market movement. Then change in fund manager style or fund management. So we would usually want to wait out such changes, because a new fund manager coming up and picking an existing fund may see some changes in the fund. Then change in return expectations from allocated funds. So sometimes we will also be wrong. There will be some funds which may not perform as we want, and if our view of the future performance has changed, that the current allocation is not suitable for the future, we may go for a rebalancing. And finally, the change in users' risk profile will, due to significant life events, for example, if someone gets married, someone has kids, the risk profile will change significantly. So based on that, we would want to do the rebalancing because the funds earlier allocated may not be suitable anymore. So just to summarize, investing for your goals, it is important to look at the asset allocation, the time horizon, your risk profile, your financial plan, and finally the investment constraints that you have, such as taxation, etc. So investing is a very personal activity. The more you can personalize it, it's better rather than just going with generals or rankings which are publicly available usually. That was my part. I'll hand it over to Vikas. Yeah, you can take it forward. Thanks. Vikas, you're on mute.
Yeah. Sorry. Am I audible now?
Yeah,
Yes,
we
you are. Yeah.
Yeah. Thanks, Nikhil, for walking through the process that we follow at Multipl. In terms of the team, it was there on the screen. If you want, I can just put it again. So here are the team members. So a well-qualified team with a good experience as well as qualification and the relevant experience in the industry.
Vikas, your screen is not shared.
Sorry. Yeah. So is it visible now?
Yes.
Yes, Vikas.
Yeah. So here is the team. The details regarding the team. I was saying that it's a well qualified, well experienced team with a relevant experience. So this is where the presentation ends, and we'll be happy to answer your questions.
Folks, you can raise your hand. We will unmute you so that you can ask your question. So if anyone
We already have a question from Rohit. Vikas, if you want to answer in the chat.
Yeah, sure. So yes, so it's a mix of human and automation. So what is happening on the app in real time is automated for sure. But at the behind the automation, as we saw, there is a human team which is working day in day out to keep a tab on the various schemes that we are allocating, to keep a tab on the market valuations, to keep a tab on the asset allocation, and then based on the various parameters, we have a defined a matrix for the allocation. So there are more than 100 combinations which are in play at any point of time. So there are 4 different risk profiles, 6 different time horizons, and then based on the amount of the goal and so on, all these factors, there are more than 100 combinations which are there at any point of time. And of course, we are dynamically changing them or monitoring them. There is a question regarding, I hope that answers your question, Rohit. And the qualitative parameters, I think Nikhil did highlight the parameters that we are looking at. Again, as I said, like the team is full-time involved in research. So we are, we do meet some of these AMCs, including the fund managers. We also listen to them at various forums. We also go through what they are promising or have promised earlier, and are they, delivering, or are they following the process which they have spoken about earlier with us. Some of the fund managers are also known to us because we have been part of the industry So even when I was at Goldman, a lot of these fund managers were our clients. So I have had an opportunity to interact with them. So I, do know that, who are following a sound philosophy and who are the ones who probably speculating more rather than having a process or approach. Because the one who is speculating, even if they get lucky, maybe they will do really well in a year or two, but they can't do well sustainably. And the ones who have a sound process and approach philosophy, they might underperform in a year or two, but on a longer term sustainable basis, they would generally do better. So there is a question on how does Multipl earn money? So Multipl earns money in two ways. One, even on the investment side, while we have had an introductory fee till now, you know that we have been conducting some surveys to see what is the best possible way to maintain our unbiased nature of advice. Because we are not doing distribution, we are an investment advisor, we are giving direct plans, so we don't get anything from the asset management companies, right? The only way for us to earn on the investment advice is from you. We will be coming out with the fee structure soon, and we will have it as a very, very competitive fee structure considering the benefit that you're getting in terms of the advice. Also, we do have an element of brand benefits, which probably all of you or most of you would be aware of, that we have tie up with more than 70 brand partners across categories. And while there is no compulsion to redeem from those brands for your goals, we are seeing redemptions with some of the partners because the deals are quite good, especially like Make My Trip. We have seen a good number of redemptions. Decathlon, shopping like Amazon, Myntra, and all. We have seen good number of redemptions. So because the deal is good, people are redeeming, and we do get a margin as well from these brand partners. But again, as I mentioned, there is no compulsion. But yeah, since the benefit is good, people are redeeming. What will be 5 top criteria to select MF depending on our goal? So see, one thing is risk profile. Obviously, we will be looking at your risk profile. What is so? This is a question by Kaustubh. So whether you are aggressive, uh, high growth, or moderate or conservative. So based on the risk profile. Second factor is the time horizon of your goal, because as we discussed, we can't give equity for all the goals, right? Equity might have done very well in the last 6 months or 1 year or 2 years, but in every 6-month period or 1 year period, equity is not the best asset class. Often, it may be the worst asset class also. So we can't give equities at current valuations. If the valuations were really reasonable, like they were in March 2020, because in March 2020, while the app was not live, but we did have the HNI service, and there, we had asked our clients to buy equities, even small and mid cap stocks. So almost 40-50% of the portfolio was in small and mid cap stocks, because that time the valuations were very reasonable for equity as a whole and even for small and mid caps. But today, for equity as a whole, valuations are expensive, and even more so for small and mid caps. So while looking at the past 1 year return, many people may want, that okay, last 1 year equity small cap has given 50%. Why shouldn't we invest in small cap for the next 1 year also? Doesn't work like that. Market doesn't work like that. So market valuations is the second important factor. And time horizon, as I said, is the third one, and amount of the goal. Because if the goal amount is a very small amount, then doesn't make sense to give you multiple funds, right? But if it is a larger SIP or a larger lump sum goal, then it makes sense to have 2 or 3 different funds. So these are the factors for your specific goal that we are looking at. And once based on these factors, we identify what the right allocation for you should be, then the next factor is the schemes. So under those categories, which are the best schemes which we can offer to you? Is there any MF on AI and EV stocks? Yeah, if I tell these to our mutual fund partners, it might be music to their ears, that if people are looking for these things, because see, honestly, there are just like asset classes, right? For most people, equity and debt are the two asset classes which might be enough for their, lifetime of personal finance journey. Same way, in both the categories, there might be a very few funds which might be more than enough. But then, people have this thing about, getting something new. And of course, the mutual fund industry would exploit that demand of, throwing out something new every time. And there might be funds which might be coming up. If there is anything existing, Nikhil, please, let me know, because I haven't heard. But yeah, if there is anything, if you have heard, then please do share with the group here. But the thing is, see, what happens is typically these funds are launched at when the hype is, the highest. Like Nikhil had given an example of infra funds. And believe me or not, but I was also one of those people who bought an infra fund back in 2007. I was a fresh MBA pass out, didn't have too much idea about things, got carried away with that whole infra boom, and bought an infrastructure fund. Now, and that was the time when, every fund house was launching an infra fund. And as Nikhil mentioned, even the 10 rupee price, right, the NFO price for some of these funds, it took 10 years to just get back the capital, forget about the return. So another example is technology funds. So like one of our mutual fund partners, they were sharing with us that, 2/3 of the SIPs, is that correct, Nikhil? No, not 2/3, sorry. One third of the SIPs.
Yeah.
Yeah, 1/3 of the SIPs. So 2/3 were in all other funds, and 1/3 of the SIPs were in technology funds. But the sad part is that while, in the early days of these funds, they made good returns, the maximum number of people who made SIPs came at the later end of the rally. So when the fund was a 4,000 crore fund, it was a great opportunity maybe because the COVID tailwinds were there. But most of the people came later, and that time, it became a 40,000 crore fund because so much of inflows came in. But by that time, technology stocks had already rallied a lot and were expensively valued. And in the next few quarters, technology stocks did really badly. And as late as mid of last year, when we were talking, most of these SIPs were in red. Now, the initial 10% people made good amount of money in those funds, but the later 90% who came in were not really making any great return. So if you can get in really early in some of these thematic funds, when the theme is just kind of taking off, then it might be great. But most of the people get into these funds only when the theme has, got some hype. And by that time, the opportunity is not as great. Sorry for the long answer, but I hope it weighs the risks there. Any further questions? You can unmute and ask as well, or you can type in the
Yeah, I
chat.
think they can raise their hands and we will unmute them. So they can't unmute themselves, but yeah, we can unmute them. If you have any questions, folks, maybe you can just raise your hand.
There is a question by Arvind in the comments.
Oh yeah, okay.
Okay, regarding wealth creation, retirement goals, while selecting travel goals, we could see opted this. Likewise, how many multiple users currently taken this goal? I don't have the data at the top of my head, but yeah, a general percentage, if I have to tell you, there are about 10% of the people who have I mean, out of the total number of goals created, around 10% goals are for the long term, roughly, long-term wealth creation. And then there might be another 10% of goals like, tax saver goals. So because we do have an option of tax saver ELSS goals also, and a few other goals which are longer term in nature. So while they may not necessarily be called long term, but people do create as a custom goal, wherein they might be saving for their kids' higher education and all that. So those would be another 10% in terms of the number of goals. In terms of the goal value, these goals would probably comprise of more than 50% of the goal value, the long-term goals, whether wealth creation or the other kinds of long-term goals. Insights over how it's performing over the years for them. So see, while on the slide, what I had shared was just the rolling return of the schemes over a period of time, a longer history. But if we look at it in terms of the last, 1, 2, 3 years, the returns on those long-term schemes which we have given have been higher than the benchmark. If you want to know in terms of absolute returns, what have been the returns? So some of the users do have returns, of almost 30, 35%, 40% CAGR as well, depending on the scheme, depending on the time they came in, all of those factors. How multiple team is handling this particular goal segment? Is it same like other short-term goals? Okay, so when you say same like other short-term goals, in terms of the allocation, yes, it is the same factors, the risk profile, time horizon, and all of those. But obviously, because these are longer term goals, typically the allocation is towards equity and equity schemes. As Nikhil mentioned, we were giving even small and mid cap schemes as well earlier, when the valuations were not so rich. We stopped when we thought the valuations were getting expensive, and we started giving flexi cap funds for those kind of profiles or requirements. And if required, if the valuations become like really excessive, like say Nifty becomes, say 25,000 in the next 2-3 months, maybe we might ask them to move temporarily into debt also. So all depends on the valuation and the time in which that valuation is achieved. So like if Nifty becomes 25,000 next year, maybe we don't need to, because it's a long-term goal. We can ride out the volatility. But if the valuation becomes really expensive in a very short time frame, then we have to see. Because if Nifty becomes 25,000 next year, by that time earnings would have grown, economy would have grown, companies' earnings would have grown. So it might be, the valuation might be more reasonable even at 25K. I hope it answers all your questions, Rohit. No, sorry, Vimal asked, I think, no, Rohit. Sorry, not Arvind. And then we have Abhishek asking, may I know if person A redeems MF via Zerodha ICICI Direct and person B redeems via Multipl, is the gain the same amount, please? Considering all parameters are exactly same, like start date, fund, etc. Yeah, see, if all the parameters are same, then the gain amount also has to be the same, because see, in mutual fund investments, this is very fundamental, not related to Multipl, but related to the industry as a whole. The regulations require that when an investment is happening, the amount goes directly from your account to the AMC's account through the payment gateway. So while we are facilitating the execution, the money doesn't come to us. Same is the case at the time of redemption. So even at the time of redemption, the amount comes directly from the AMC to you, not to us. So there's no question of having a different amount. Will the amount be the same as what reflects in your current value? It may not be if there is an exit load. But then again is a scheme thing. That is not a Multipl thing or a Zerodha thing. So if the scheme has an exit load, it will have the exit load on both the platforms, not just for us. So in short, the answer is yes, the gain amount would be the same irrespective of whatever platform you use. Now, if the platforms charge you specifically something in addition to that, based on some mandate which you have given to them, that is separate. But yeah, the gain amount has to be the same. The redemption amount which comes into your account also has to be the same, because as per regulations, it is supposed to go directly to you, not to anyone else. Yeah. Any further queries? Please do share your feedback. Kaushik has shared the link. Kirtana has shared the link for the feedback right up there in the chat. So please do share. And
Yeah, Vikas, the
yeah,
feedback link which was shared was for the questions. Now we will create a separate link for the feedback form. Like we will do a feedback form now.
okay, okay.
So yeah, that will be shared in 2 minutes. Yeah.
So yeah, is this the feedback link, Kirtana? The one which you have shared just now?
No, this is for the questions.
This is for the questions.
Okay.
Yeah.
Yeah, please do share the feedback link while we wait for any further questions. I think there is one more. In case we do not want to redeem the investment with brands, how is your platform different from any other mutual fund platform where I get to choose the mutual fund and decide the allocation of funds? Also, will Multipl give us a consolidated statement for tax calculation? Yes, we will give you the statements for tax calculations that we will help you out with. In terms of the funds, if you're not redeeming with the brands, Multipl is different in the sense that we are advising based on the various parameters that we discussed. We are not telling you that, okay, here are the funds which have done very well in the last 1 year and go and pick it, because then you might end up picking a small cap fund today, which may not be the best fund to choose for the future, right? So see, I'll give you an analogy here. When you're driving, you do have the rear view mirror, like for reference, but you have to drive looking at the front. You can't be looking just in the rear view mirror. Is the case with investing. So while we also look at a lot of the past data as a reference, but we can't invest basis that, right? We have to use our valuation frameworks. We have to use the other parameters like risk profile and other factors, and see how in the future, whether it's a 1 year goal or a 10-year goal, how in the future things could perform based on the probabilistic outcomes, right? Because investing is a probabilistic game. It's not like a deterministic thing where you can say for sure that, okay, this is the input, this is the output. So sizing up those probabilities is really important. And that can be done only if there is a framework, and based on that, we allocate. Now, does that mean that we will never be wrong? We will be wrong sometimes. But investing is more about being more right than wrong. So if 10 times are there are 10 say instances, maybe in two maybe we may falter, but in the other 8 instances we might do really well. So on an average, because we are working based on a process, based on a certain discipline, a certain framework, on an average we would do better than a random choice of funds based on just the past returns, and that to past point in time returns, right? Like not rolling returns. So most of the places what you see is just 1 year, 3 year, 5 year point in time returns. These are not even rolling returns that in any day if you would have invested, what would be the return? This is just a point in time return. So not the best approach, but unfortunately in India, the market is still a very product sales oriented market. It is not a solutions advice oriented market. So 99% of the people are being pushed products which may or may not necessarily be suitable to them. But maybe because they are easy to sell based on showing the past 1, 2, 3 year returns, they are being sold. So I hope that answers your question. And also the rebalancing, right? As Nikhil mentioned, we are doing rebalancing as well, which I don't know if any other platform today is providing in the manner that we are providing it.
There are some more questions at last.
I have to keep scrolling down, sorry. As technology continues to evolve, how does Multipl app approach leveraging data analytics and AI to provide personalized and robust mutual fund investment strategies for users looking to achieve their long-term financial goals? Okay, so maybe I can share a quick anecdote here that how did Multipl, come to being in the first place? Because after quitting Goldman Sachs and after completing my level 3, I was happy managing my own small stock portfolio. But then one of my IIM Indore batchmates, he asked me to advise him. I was initially reluctant, but he was persistent, so I became an advisor. And he said, I want professional advice, not friendly advice. So I had to register with SEBI as an investment advisor and become his professional advisor. Then one day, I got a phone call from a GS colleague who also wanted advice, but my minimum ticket size at that time was what the PMS limit at that time was, which was 25 lakhs. And she said that she doesn't have that quantum of savings right now because of various reasons. And I said, for me, it is not feasible to, provide advisory services below this ticket size. And then she was quite disappointed that who should we go to for advice. And that is the time I thought how using technology, we can provide HNI quality advice to retail investors who are investing in smaller ticket sizes. And that was the thought process with which, I had started, and then met Paddy and Jax, my other co-founders. Of course, before we launched Multipl, we pivoted a bit in terms of the aspirational goals, because Paddy and Jax come from a non-financial, non-investment background, and they said people, align more with their aspirations. And maybe we can get them started with these aspirations to get them into the habit of saving and investing. And then we can nudge them towards the longer term goals, which are all available on multiple platforms, as we just discussed. And is it like practically possible to provide HNI quality advice through an app? Today it is not, but yeah, maybe using some of these newer technologies, maybe we will reach to 100% of HNI quality. So today, maybe we are at 50-60% of HNI quality advice, but which is still far better than probably what people were receiving from distributors or bank RMs who are just pushing products without understanding the suitability. So if you were getting maybe a 10% of what an HNI would get, maybe with Multipl you are at 56%, and we will endeavor to take it to 100% using the latest technologies which are available, and we are exploring and experimenting with them to see how we can make it more personalized, more robust, because see, what we provide on the HNI side is viable because it's a higher ticket size, a different fee structure, everything. We can be personally accessible to them, have a more comprehensive financial planning, everything. On an app where even when we start charging, it will be a very nominal fee. It's not commercially viable today, but maybe hopefully using technology, we will have a as good a quality of advice and engagement, because advice might still be pretty good, but it's also about the engagement, right? Because we can handhold people when we are interacting on a one-to-one basis. We can help them navigate through the ups and downs. So just to give an example, like in February 2020, I asked clients to liquidate because I was lucky to know about COVID a lot earlier, because one of my batchmates was working very closely with pharma industry. He's a very good friend, and he had brought this to my notice way back in January 2020 that this could be something really serious. And I was keeping a track of it. And then finally, in the last week of Feb, I did ask clients to liquidate when things in India were still very normal. People were just going around with business as usual attitude. And that time there was a bit of reluctance because I was talking to them always about long term, and suddenly I was asking them to sell. But then I did push them. Fortunately, they did liquidate. Nobody liquidated 100%, but they did liquidate some bit of their portfolios, 20, 30, 40, 50%, whatever they could, based on the pressure from me. And then in mid-March, now they were in a state of panic. And this time I pushed them to invest back in markets, because based on the valuation model, the market valuation was equivalent to the lows of dot-com bubble burst, equivalent to the lows of global financial crisis. Of course, there was a lot of uncertainty in terms of where the markets would head to in the near term. But what I told them was, if you invest for at least 2 years, whatever you can spare, the money that you can spare for after keeping aside money for emergencies, assuming that you might lose your job, you might have a big medical emergency, everything, keep the money aside for that, and whatever remains, just put into equities. So this kind of hand holding, wherein when people were in a state of panic and I could literally call them, push them. Hopefully we will get to that stage also at some point of time, wherein we can get it to 100% quality, which HNI receives on the app itself at a very reasonable cost. Then there is another question from Shivam. If I'm gaining profit of 10,000 from mutual funds and loss of 15,000 from share market on 2 different platforms, what will be the tax calculation? These 2 things will be clubbed during my tax calculation or not? Yes, you can set off depending on whether it is long term or short term, because the rules are different. But the platform doesn't matter. Irrespective of the platform or the instrument, you can offset. But for offsetting, there might be differences. So a long-term capital loss can be set off only against a long-term capital gain. So that is something you will have to look into, whether it's a long-term gain, short-term gain. So that probably is something you might have to look into. Do you rebalance in the middle of ongoing goals if you think the already selected not doing good? Yes, we will, if the fund is not doing good, in the sense they are not following the process, and they're not maintaining the discipline of following that process which they have defined, or the philosophy which they have defined, or the mandate which is the mandate of the fund. Now, see, there will be times when some funds will underperform, even if they are holding very good quality companies. They might underperform. There are funds like that, right? Because there is always in markets, different sectors will be in vogue at different times. Different investing styles will be in vogue at different times. So if the fund style is different than what is in vogue, they might be underperforming. But that doesn't mean that it's a bad fund. So for example, some of the access funds, they have underperformed massively because uh, they follow a particular style. So should they change the style and chase the style which is in vogue? No, not at all. Because if they continued following their style over a time, their performance will still be very good. And that is based on data. It's not based on some estimation. It is based on data. Historically, the approach has worked over a longer period of time, and it will work again because there is a certain process, certain defined approach to it based on certain quality parameters and all of those things that they are selecting stocks. So we will monitor, but yes, sometimes if the fund managers are not following the defined process, if they are not delivering what they have promised, then we will go for a change. So if there is a underperformance because of the factors specific to the fund manager or the asset management company, then we will go for a change. But if the underperformance is because of market factors, we may or may not go for a change depending on how the fund is responding to that market situation. Yeah. So Kaushik has shared the link for feedback. Please do fill up the feedback form. If there are no further questions, maybe we can close the session. But please feel free to reach out to us either in the group or at support@multipl.xyz. Kaushik, you want to? I don't know if all the members here are group members. If not, do you want to share the group link?
Yes, Vikas. I'll be sharing the group link. I think, yeah, most of the folks must be from a group, but I'll be sharing the link as well. Just a second. Folks, feel free to help us understand the feedback, how the session was, and whether you liked it, how we can improve further with the upcoming sessions. We are, as I mentioned during the call, during the start of the call, so we are planning a lot of sessions for the upcoming weeks about how multiple works. So today we got to understand the mutual fund advisory part, and we will soon have different sessions covering all the important aspects of the multiple, right? So feel free to let me know if you personally want, personally have a suggestion for any topic. We will definitely acknowledge that, and we want to hear from you on what you would like to listen to. Yeah.